Look at this image of early solar installation. Perfecting the timing of the solar infrastructure boom in the early 2010s redefined investor portfolios. Today, the energy market stands on that exact same historical fault line, but the catalyst has shifted to green hydrogen. Green hydrogen provides a complete molecular restructuring of how heavy industry generates, stores, and transmits power across the globe. For early capital, this is a fleeting window to position for a 10 lakh crore economic pivot before the mainstream consensus prices in the magnitude of this transition. The National Green Hydrogen Mission is designed to achieve national energy security and eliminate 1 lakh crore from India's annual fossil fuel import bill by 2030. It targets a baseline production capacity of 5 million metric tons per annum to shield industrial productivity from volatile global energy shocks. That ambition is already backed by hard capital. The initial allocation of 19,744 crore has moved from policy formulation to aggressive on-ground execution, with early competitive bidding successfully locking in production prices below 400 rupees per kilogram. Smart money is prioritizing the industrial manufacturers capable of building the machines that build the clean energy. This creates a multi-year runway for firms focused on the foundational architecture of the industry, rather than simple technology upgrades. To understand the scale of this transition, look at the legacy giants currently pivoting their entire business models. Sovereign-backed entities like NTPC and massive conglomerates like Reliance are committing tens of billions of dollars to construct sprawling, multi-gigawatt green energy hubs. Indian Oil Corporation holds a unique advantage by acting as its own ultimate captive consumer. By integrating green molecules directly into its existing refining network, the corporation removes the primary demand-side risk that stalls independent developers. While these megacaps provide baseline stability, the most significant price inefficiencies lie further down the pipeline. To find the highest alpha, we must focus on the specialized hardware solving the industry's specific physical bottlenecks. The primary invisible bottleneck is the electrolyzer, the machine that splits water into hydrogen and oxygen. Right now, manufacturing these systems account for up to 57% of the total cost of green hydrogen production. Alkaline electrolyzers are cheap, but react slowly to renewable fluctuations. PEM technology offers dynamic response, but introduces geopolitical risk. PEM systems rely on rare platinum group metals. With South Africa controlling 85% of iridium, manufacturers are tethered to a fragile oligopoly. This vulnerability creates a massive opening for agile domestic champions. Advait Infratech is scaling localized manufacturing of advanced alkaline systems designed to bypass global material traps while dropping capital costs toward 2030 targets. For the largest utility-scale installations, the industry turns to Larsen and Toubro. They are securing decades of predictable annuity cash flows by acting as the primary architect for multi-billion-dollar infrastructure like the IOCL Panipat refinery project. Building these complex machines domestically serves as a multi-billion-dollar economic moat, creating a highly lucrative subsector for those capable of deep component indigenization. Hydrogen has exceptionally low volumetric density. Transporting it efficiently requires aggressively fighting the natural physics of the molecule itself. This forces engineers into two extreme solutions: compressing the gas to a crushing 700 bar, or utilizing specialized double-walled tanks to cryogenically freeze it to minus 253 degrees Celsius. This creates a niche for specialized toll booth operators. InoxCVA dominates the domestic market for cryogenic containment and export tanks, while Kirloskar Pneumatic provides the mechanical muscle through high-pressure diaphragm compression systems. To bypass the astronomical cost of new pipelines, GAIL is actively retrofitting its 15,000-kilometer natural gas network. These existing arteries represent the lowest friction pathway to blend hydrogen into the national energy grid. These mid-cap enablers operate as infrastructure toll correctors, securing revenue from every kilogram moved, regardless of which megacap ultimately wins the race to produce the cheapest molecule. A credible thesis requires a look at the systemic risks. Green hydrogen production is intensely water-intensive, requiring between 18 and 32 liters of highly purified water to yield just 1 kilogram of fuel. India faces a direct conflict in its geography. Regions with the highest solar irradiance and wind potential are simultaneously the nation's most severely water-stressed zones. This geographic constraint contributes to a significant execution lag. While 158 projects have been announced, 94% remain stalled, waiting for firm buyer commitments and adequate water infrastructure. Building expensive desalination plants increases system costs, threatening the $1 per kilogram target. For the 2026 to 2030 cycle, capital must first flow to the machines that build the clean energy. Successful investors will focus on the highly specialized toll booths of the new infrastructure, rather than chasing the raw fuel producers.